Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you gotta get spotted. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning. Oh, we gotta start the music. Oh, I guess I'm a little bit late here, guys. I'm so sorry. But you know, it doesn't matter. We got non-farms. There is no way I'm going to be taking any trades during this because this is going to be bonkers. We had a bonkers market yesterday. We had a bonkers market the day before. I really can't predict what's going to happen. I'm very concerned about if the headline private payrolls number ends up being above 200,000 again. Yes is already up 100. Is it now? No. Low is 5190. Jeez. Okay, 15 seconds here. Oof. Holy fuck!
Oh my gosh.
Are you kidding me? Wait, why did the treasuries sell? Okay. Headline number 303,000 versus an expected 214. Private payrolls 232 versus 170. That was the number that was kind of like, we're over 200. Jeez, what the fetch? And where is average earnings? Average earnings is in line. Oh, you know what? I'm like super slow today. I'm like, why did the treasury sell off of that? Yeah, the treasury should sell off of that. I had everything backwards in my head for some reason. That's really weird. Yeah, I guess I'm just like not locked in yet. But holy fetch, man. I'm really starting to come very solidly. I mean, look, I've never been, this is so hard because this whole time since last October, let's say since last October, I've kind of been like, you're not going to cut rates. Why would you cut rates? Like the market is still hot. And usually the way that this works is you keep rates up there until the market falters. But look, there is some point at which you want to reduce rates, but that's after things are kind of done and past, right? And it's not now. And so Kashkari, him saying yesterday, well, before I said to, but now I'm kind of thinking that maybe we don't have to do that at all. And now you're getting non-farm numbers like this kind of coincide with that. Now we get to have the same discussion that we have every week with Uzi saying, not every week, every month, saying those numbers are fake AS. Well, there appears to be some sort of long-term discrepancy / bias in the numbers. I'm not going to say that they're like being goal seeked higher or anything like that. But I do think that there is something about the methodology and the way that they're doing the numbers that the analysts have just not figured out yet and continue to get wrong. Because how can you be under expectation? Sorry, how can your estimate be under the actual so many times in a row and be that wrong so many times in a row, right? There's something going on there that you're missing. Now, if you were goal seeking the numbers, right? Last thing I would want to do right now is have a number that's too high. Hey, Jeremax, how you doing? The last thing you would want today for the stock market is a high number, right? Like this number does not help Biden. You might think, oh, high employment, that's really good. But it's not a good thing for the market, because that means that they're going to have to continue to keep rates high. And frankly, it increases the probability of there being a recession this year. So I don't think it helps them. But that's why I'm saying I don't think that you can come in and you can say, okay, this month the consensus expectation is this, and this is what we think would be best for us in our election. So let's put a number out that is X, right? You can't, I don't think that they can really do that. I mean, it is an organization. There's multiple people working there. There's people that would be whistleblowing, yada, 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 right? Here's the way that I think that it works. The way that I think that it works is you come in and you have a meeting about the changes that you're going to make to the non-farms payroll methodology this year. And you come in and you say, oh, hey, there's, there was all of this inflation and everything, and it kind of creates these effects. So I think that we should compensate for it this way. And then somebody else says, oh, I think that we should compensate for that or base it off of these numbers instead. And then you subconsciously, because you're pro-Biden or something like that, you say, well, I want it to be this way because that would result in higher employment numbers overall, right? And so then you set that methodology, and then for the next year, 2 years, or however long you have that in your methodology, the numbers are hotter than they probably should be. That's what I think happens. So then all of the thing that doesn't fit with that is, okay, they changed the methodology or whatever and the way that they do their adjustments. So then shouldn't all of the analysts know that and adjust their models accordingly? But we continue to beat them out every month. That's the thing that I don't get. Nobody can explain this. Another thing I do want to point out, well, and I'm sure we'll be in there in those numbers. We'll start digging into them a little bit more in a second. But another thing that I do think is going on is that you are getting a lot of illegal immigration in the United States right now. And I mean millions and millions of people. And those people, if they get jobs, those could potentially show up in the payrolls. Which is probably, which might be seen in things like the payroll survey and the household survey diverging, right? Because the illegal immigrants are going to be much less likely to get called for a survey, but they might show up on payrolls. Okay, so let's come in and see if we can find the revisions, because that's a big part. Fed swaps shift full pricing of rate cut to September from July. Oh, wow. So now they're saying that they don't think that they're going to raise rates until September. Potentially, I bet it is. I would nearly bet money on it. There is some evidence that that is going on, for sure. Okay, so another month of very solid hiring for the U.S. payroll growth rose by 300. Unemployment rate ticked down to 3.8 from 3.9. dude, when I saw the number and I saw it was a 300 again, I was so shocked. I was so shocked. And the treasuries sold off pretty strongly there off that too. Basically, they took out all of the flight to safety that they did yesterday. Where's my revisions? Where's my revisions? I guess I have to do this the hard way. Okay, the change in total non-farms payroll employment for January was revised up by 27,000 from 229 to 256,000. And the change for February was revised down by 5,000 from 275,000 to 270. With these revisions, employment in January and February combined is 22,000 higher than previously reported. Monthly revisions result from additional reports. Okay, so this is actually one of the, well, it's not the first time, but they actually revised the numbers higher. So the revisions were actually, let's say hawkish. You know, what's the best description? You know, hot. The revisions were actually hot too. Dude, so the dollar, of course, took a big jump, and they're kind of in their sideways action now. That when I look at the treasuries, like, they look like they're ready to go. Like, they look like they could sell plenty more, but they're probably going to need the dollar to do it. Okay. I don't know if I agree with that. So I think that I should give you a chance, though, to go deeper into it. You say the existence of revisions makes the numbers basically irrelevant. I think that it's perfectly okay to say, okay, here's all of this data that we get on employment. We're going to give that data to you now, and then there's other data that comes in that might update that later on, but we'll give that to you next month. That's okay, because they're still giving you the information that they have. Like, we want to think of it as like you know, it's like there's this one number that's supposed to be perfectly reflective of what the employment situation is in the economy. That's impossible, right? All we can get is data points to kind of update us on what it is. So I don't think that you know, it's just like with GDP. There's revisions, right? They do the first estimate, second estimate, third estimate. I mean, everything in trading and markets are like that, right? The more on the cutting edge that you get, the more error there's going to be in the information that you're getting, right? If you're trading off of a moving average, the faster the moving average is, the sooner you'll get into the trade, the more you'll make on the trade, the more trades that you'll make, but the more your win rate will decline because you'll have more false signals. The same thing with economic data. This comes back to another thing that is, again, it's like, surely people know this thing and are digging into this, but I never see it. Why aren't they talking about this? What is the difference? what is the specific data that comes in after this number that factors into those revisions? And why has it been coming in adjustment higher most of the time as of late? Makes no sense. But the thing that really doesn't make sense, man, again, how do the analysts keep getting it so wrong? Something broke markets on Thursday. If an asset weak without an obvious catalyst, it suggests that it can really get destroyed if a genuine risk materializes. I don't think that that's true, actually. So let's talk about yesterday. We got to talk about this. So, first of all, here's the Treasury. Or no, that's the E-mini. Let's start with the Treasury. Okay, so here's the Treasury. Yesterday, we had a little bit of positive news. And then we fell back. This jump up, I was kind of like a little weird. Like I didn't completely understand it. This jump up right here was news story that there was an alert put out by Israeli embassies to be on alert. They think that Iran is going to make a revenge attack for the damage done to an Iranian embassy. Some sort of tit for tat sort of a thing. So that's what that jump up was. I should note that Kashkari was also made his comment about that they're going to, he doesn't think that there's going to be any rate cuts now, or at least hinted that that could be the case. And the Treasury started selling off of that a little bit, but were relatively, I'd say, unbothered. They reacted to this jump up here more. It was very clear when you come over to oil. Oil like really jumped on that geopolitical stuff. Okay, so oil really jumped, and then ES fell apart. Now the thing is that part of this move was Kashkari, and then part of this move was the Israeli embassy thing. And I don't think that the E-mini was really even necessarily reacting so much to the Israeli embassy headline as it was reacting to oil itself. Can I perhaps show that? Let's see if I can show that. So here's my oil chart. Here's when we jumped. If I really zoom in here to it. Okay, and here's the E-mini. Okay, so here's where the E-mini flipped around. I guess they were pretty heavily correlated. But here was about the time when oil really started taking off and when the E-mini started taking off. And that was after the geopolitical headlines. Kashkari happened like back here, I think. Okay. So that's what I'm trying to get at with that. So here's the thing, though, is that the Israeli story, that's not one that like just comes out over the news squawk, right? I didn't hear it on the news squawk. I couldn't see it on Twitter. It wasn't, I went away for a few hours and came back and then went on Zero Hedge, and then they were kind of talking about it, right? And they were speculating, but people still weren't sure. So when the market doesn't know what the piece of information was, the volatility lasts longer. And because we were so long in the options and all of that sort of stuff, you end up with like a really big burner. So I think it was a combination of those factors and not necessarily something that like suggests that the overall structure of the market is really weak per se. Okay, but it's not a good thing in the midterm for the market, right? Like, this could be the start of a more extended downturn, especially now that the employment numbers are just continue to be too high. Right? Was that the no? All that happened. So yes, it was a bombing in Syria. So there was an Israeli bombing. Was it Syria? I think it was Syria. And like the Iranian embassy was damaged. So they killed like an Iranian general or something like that. And it hurt the embassy. But it was not, Israel claims that they didn't like attack the embassy itself, but that was, you know, maybe it just bursted some windows or something like that. I don't know. Anyways, Iran was very upset about it. They're like, this is going to be a war. We're going to do something about this, yada, yada, yada. Right, okay. Israel has put all of their embassies on alert because it's going to be tit for tat, right? You attack Iranian embassy, they're going to attack Israeli embassy. ZB took it all back. Yeah. So I think that you come in and you look at it, it's like, okay, oil goes up, oil-induced recession, treasuries started going up because one, geopolitical fears and it's a flight to safety, and two, because maybe we get like an oil price spike induced recession sort of a thing, right? So when you look at the treasuries are going to follow what the Federal Reserve is going to set the interest rates to, right? So they might not be telling us, the treasuries might not give us an accurate look into the probability of an oil price spike induced recession at the moment, at least. Well, the treasuries, you know, they kind of had that rebound that you always get, fall back into the liquidity hole. I would say that the pressure is still very much sell because they did not come very far back at all. So I think that our chances of, you know, not coming back very far and then selling and making new lows in the treasuries are probably higher than they usually are. But I think that the probability of it, you know, like really retracing back pretty far, like let's say to 24, are also somewhat higher than usual, just because of the volatility that we've had. And when you get these sorts of things, like you can just get really bizarre, nonsensical moves sometimes. So I think I'm gonna sit on my hands for now, especially since when I was like, why did the treasuries sell too? That was like a really dumb thing. Like, of course they would sell. I don't know what I was thinking when I said that, but that kind of makes me think like, okay, it's been a long week. You've been working hard, Seth. Maybe you're just not on the top of your game today, you know? I'm just browsing around here a little bit, see if there's anything else about all of this that we can kind of glean. You know, one of the things, I didn't really have enough time to talk about it, but one of the things that I was kind of thinking before going into this non-farms was, I thought, well, with everything else that has happened this week, is non-farms actually the most important thing this time? Well, because the number was so big, it's pretty important. Because the number was so big again, I'd say it's pretty important. Like, they can't continue to get job reports like this. They will have to raise rates again. This can't continue much longer before you have to raise rates. You know, like the market was thinking June. If the next reports that we get until June are all hot, then I think that the market is going to have to start pricing in rate hikes. So too early for me to start speculating about that? I don't know. Again, the whole situation is just really weird for me to look at because I've kind of been all the way back to September being like, why would they cut? We're not anywhere close to cutting. Why is the market pricing in cuts? Cuts aren't going to happen. And then there was this whole rally sort of a thing that I was kind of like, this is too far. This doesn't make sense. These prices don't make sense. That said, an interest rate of 4.385 sounds perfectly reasonable to me. They just slapped Powell's speech from 2 days ago with this number. So this just a remind again on the political side of this, right? The thing that I think is funny is that the conspiracy theory is that they are fudging the numbers to help Biden, right? These numbers do not help Biden. That's the funny thing. So the market has been kind of rallying on this whole thing that like they're going to cut rates because they want to help Biden for his reelection and all of that sort of a thing. That whole kind of theory to me is a little silly. It's a silly trade. I'm not going to say it's a silly theory like that could never happen because it has happened. I'm not sure that that's what's happening right now. There's a lot of things that don't make sense, okay? But I'm not sure that that's what's happening right now. But the trade itself, in my opinion, is a little silly because if that is what's going to happen and you trade on the rates going lower or whatever the deal is, right? That's immediately going to feed back into the economy and create inflation, and then you're just going to get hosed by the inflation. So, like, that long everything in that situation, I don't think is actually a very wise, maybe in the short term, but not in the long term, you know? And I think you can just kind of see that with Powell's speech, where he was kind of like, well, we kind of think that the employment is going to come down. But then when it doesn't, you immediately get savaged. We're in an extremely uncertain time when it comes to economic data, and the market keeps acting like it's not. And they're paying for it today. They're paying for it today. Holy crap. I'm going to read that headline. That one's kind of a little scary. So yesterday, after like all of the craziness, oh my gosh, the stuff on Reddit. Ooh. I keep forgetting to ask you, how is the order entry in Jigsaw with the ticket increment 2-4 for the DOM? Will the limit orders be placed on even only? I believe so. So if I put a limit order right there, and then I come over here to this window and I say orders, and it says placed 52-14-25. Oh, okay, no, I'm wrong. It will place it at the bottom of that. So this box, that's interesting. This box represents the prices from 5201.25 to 5202. So if I put a limit order there, it puts the limit order at the bottom of that range. So the 51.25. So conversely, if I put a stop order that, oh, actually, that's not what I wanted. It just reset my DOM, that's all. Okay, if I put the stop order in there. Oh, did I just close that window? Silly me. Now I have the stop. The stop is at 5202, right? So you got to think of this box as a range, and when you put a limit order in, it will put it at the bottom of that range. There might be ways, let's see, is there settings for that, though? I think there was some settings involved, wasn't there? No, when I was looking at the last price there, it was at 50.0202 because it was a stop, right? So your buy orders will be at the bottom of that, and your sell orders will be at the top of that. Oh, that's right. You can do both up, down. I don't know. I find the tick aggregation really, really useful for watching the S&P 500 because I get a better overview of it. But I think that if I was going to be actively trading this, that I would still want a second DOM that is per tick to put my orders in at. And to try and like catch the edge and things like that. No, I mean the buy limit you placed was at 52.02. No, it was not. So let's put it at 5,200 since the market has moved down a little bit. Let's put it at 5,200. So it will actually be 51.9925. So there's the order right there. It's showing it at 5,200, right? But when I pull up this orders thing, was it limit? Oh, no, it's not doing the same thing that it had just done to me before. Oh, no, wait a second. I mean, now I need to go back. Now I need to go back and watch the video because it did something different the last time. What's with that? Now it's putting it at the even number. Where was I getting the 52.25 then? Well, now I'm confused. Do you know how to trade like Gary? Generally, yes. I would say that to trade like Gary, to trade like Gary requires a lot of practice and experience, and I have not put as much into it. Was I looking at the last price column instead of the limit price? Who's Jerry? You know, Jerry Seinfeld is worth $1 billion now. The last great sitcom. There was many great sitcoms after that, but they all kind of like blew the pooch at the end. So Seinfeld is kind of the last great sitcom of all time, really. Maybe someday sitcoms will come back, but I'm kind of thinking they won't. But I don't know that much about entertainment, so I could be wrong. Okay, you said at the numbers release that you don't get to ease rates before markets cool down. Don't financials price in future expectations, so I think ES will melt if and only if rates finally cut. Well, okay, so I think that the market tries to price in future expectations. It's not very good at it. The first thing we got to remember about is that, okay? But it is the case that the market has kind of been thinking that like economic weakness is coming, and then the problem is that you're not seeing it in the data, right? Like the market has kind of made a prediction, and the further along we get, the more that it's like, no, you're wrong. That's how I see it. Yeah, the S&P 500 DOM is moving around. The S&P is moving around enough that the DOM is resetting on its own. But so far, the market is not pricing rate hikes. They've gone from maybe we'll do it in June to, from what I heard on my news squawk, September now. So, you know, but that's because of the way that those curves and everything kind of work. Okay. So that doesn't necessarily mean that's a prediction that it's going to be September. It's just that the price has changed enough to move the indicator that we get to September. It could continue going. Who knows? My point is, markets will correct only when rates are finally cut. You're saying, I think that the S&P 500 will continue to rally until the rates get cut? I you would be specific about like the time frame and the sequence of events that you think will happen, right? Okay. I don't think that that's the case. So, if the market expected scenario is correct, which is that the Federal Reserve does end up cutting interest rates in September, and they end up bringing interest rates back by 50 to 75 basis points, then I don't think that the market ever corrects. I think that they will just continue to push up bullish, and it will just continue to be a bull market. The market will only flip around if they are seeing a recession coming. The Goldilocks scenario is not a recession. It's a soft landing. Soft landing is accomplished. You bring rates back down. Right? What we're seeing right now, so you've got these different scenarios. Where's my pen? Or no. Let's do it this way. Discussion. Okay. So. Scenario 1. Soft landing. Okay. That means rates are cut 50 to 75 basis points. Bull market continues. Okay. Scenario 2. Inflation reignites. Rates are not cut, possibly even raised. Market pulls back. If pulls back or goes into bear market. Scenario 3 is a recession. Okay. Recession brought on by either oil spike or by rates being too tight. Okay. Market goes into bear market. Those are like, what would scenario 4 be? When we finally get into the first recap, then the news is going to be, when will the Fed stop cutting rates? Oh my gosh, you guys. And that would drive yields up and corrects assets down. Well, I have no clue what they will do, what the rates market will do after they make the cuts, right? Because at that point, then it will be like, what's the next step? And I'm not sure if I can see that far ahead. I think that the rates would probably, stay pretty close to where they were at that point. Because this scenario here is like, okay, the federal funds rate came like way up. Okay. And then they're saying it's going to come back like that. And then it's going to go like this. Right. And so what we have seen with the treasury markets, the treasuries themselves go the opposite way. Right. So they got hammered really hard. And now they've kind of come back, and we're like right here. Okay. This is now. Okay. So if they do cut, right, then rates should kind of come up like this, but then they probably start to go sideways, right? They probably start to go sideways until they get to the point when they expect that there is a recession, and then they'll rally, right? The Fed starts cutting rates. They cut like 3 meetings in a row. Inflation spikes again, and they refrain from cutting markets. Correct. So that's not. I wouldn't say that is a scenario 4. That would be scenario 1, and then we're going into the next time period. And one of the scenarios after scenario 1 is then inflation reignites. Right? So like we could call it scenario 1A, right? Scenario 1A, after rates cut, inflation reignites. Scenario 1B, after rates cut, rates are held steady for several years. The most likely scenario, according to the market, is 1B. Well, why are you doing that? Why are you doing that to me? I still get these weird things where like it doesn't, if I do circles here, I kind of get those little like, I don't know what causes that. It's something like with everything else running, it's like the process gets interrupted or something. I think it's NinjaTrader. I think that it like can't handle something else taking the GPU. Okay. Scenario 1B is the scenario that the market thinks is going to happen. Yeah. Markets are pricing in scenario 1, but they're also pricing in scenario 1B. Yes. And I think that there is a good chance that scenario 1A happens. But I still think that scenario 2 happens. So let's split that one out, because here we said inflation reignites. Okay. So then scenario 2A is rates are not cut. And scenario 2B is rate hikes. Rate hikes and what would we call it? And replay of 2021, essentially. So in this one, where rates are not cut, the equities will pull back to reflect the more accurate interest rates. That doesn't necessarily have to lead it into a bear market, but they will have to reprice. Okay. So the market thinks that it's going to be scenario 1B, and I think it's going to be scenario 2A. And I've been saying that it's going to be scenario 2A since last August, essentially. That they're not going to cut rates. That rates are just going to be where they are right now for a really, really long time. What has happened this week is markets are starting to go, actually, Seth's scenario is more likely than we realized. More likely than we realized. I think that a lot of people, that the main reason they believe in scenario 1B is because it's good for them politically. This scenario 1B is the most favorable scenario for Democrats, essentially. It's frankly the most favorable scenario for if you're long the market too. And that's why I'm saying, like, the market has this bias to think that the S&P is going to win out always. So that's why I think that they are overestimating the chances that 1B happens. You say, I think Powell will tease rate cuts just so markets don't freak out this year because Biden might do. So let's say that I was the Federal Reserve president. Okay. If I was the Federal Reserve president, I would be saying what I think right now, which is, well, the data that we're getting in right now shows that the economy is still very strong, but inflation is coming back down. So we want to ensure that inflation comes back down to target, and we're not going to cut rates until it comes back down to target. But it looks like that the economy is doing pretty okay in spite of the high interest rates. And that's what I would be saying. Which is not that different from what Powell is saying, which is that, well, it does look like inflation is coming back, and so we think that we should be able to cut rates. And the only difference between me and him is I'm more concerned about the continued economic strength in these non-farms numbers. Okay? Like, that's the difference between us. Okay? Now, let's say in this theoretical world that where I am the Federal Reserve president, and I'm saying that, and Biden's not happy with that. Biden wants interest rates to be cut. And he comes to my office and he says, hey, Seth, I need to be reelected. And for me to be reelected, we need to cut interest rates. So please start telling people that we're going to cut interest rates. Okay. So first of all, if I was Fed president, most likely thing for me to do would be to say pound sand. Right. I'm going to do what the Federal Reserve's mandate is based on the data that I'm getting without any political considerations. That is what the Federal Reserve is meant to do. The entire structure was built and created so that the Federal Reserve could be independent of those political influences. The political people will try to influence the Federal Reserve, and they have succeeded in the past, and that's what happened under LBJ or whatever it was when inflation ignited in the 70s, and they didn't, and then you had a second wave of inflation. That's what caused the second wave of inflation. Remember that one, because a lot of people will think that like the tendency for inflation is you'll have a first wave and then there's always a second wave. But we don't actually know that, because that second wave may just have been LBJ bullying the Federal Reserve and the Federal Reserve going along with it. But there's another thing that I could do. I could say, okay, I'll do what you say. You know, I want to play nice. This is what you're, what you think you need to do for the economy. And we want to best support that as well as we can. And so we'll play along and tell people that, we keep talking about anticipating lowering rates so that the market can be as strong as possible for the election. And I'm going to say that knowing full well that if that's what we do, that it's going to hurt him. I would do it because I think it would hurt him. If I was the president of the Federal Reserve and I wanted to hurt Joe Biden's chances of re-election the most, I would be telling people that we're going to cut interest rates with the intention of causing inflation to reignite. Because the thing that will kill Biden the most will be another market decline created by inflation. Right? Scenario 2B. Scenario 2B is the most disastrous for Joe Biden. I think 2A is going to happen. But if I tried to manipulate the market and ran it too hot, you're going to create 2B, and that's the worst one for Biden. So that's why I'm like, this trade that everybody thinks that they're going to keep things easy and risk inflation reigniting to try and help Joe Biden. I don't feel like that the long-term trade-off of that makes sense, because the long-term trade-off of that is not buy equities, right? The long-term trade-off of that is buy commodities, be long wheat and oil. We should probably be long oil. I was kind of looking for the right time to do it. And I think that I waited too long. I think I missed my opportunity. I wasn't like really heavily looking to buy something. My mind was more like, oh, I'm going to take care of this and this and this and this and this. Now I'm to the point where it's like, I got a little bit. I would be willing to buy something. I kind of want it to be energy right now. And I feel like oil is already up too much, and I'm concerned that this might be the ceiling on oil, depending on which of these scenarios that go on, right? I mean, if we're going to have scenario 2, then oil's probably going to keep going. $312.39. I'm thinking about my Epic Pen and how it still has this problem, and I'm wondering if they've had a new release lately. Okay, so they have created a new version, but they just adjusted the EULA. Okay, so I don't know why, but we keep I keep forgetting to take the notes. So let's do that. Close. Non-farms. Inflation fears. Global risk fears. Oil prices. I'm going to list that as a flow. That's kind of a conditional flow. Friday flows tend to be early. That is to say, the later in the day that we are, the less likely we want to take a trade, because the good traders, they make their money right at the beginning and then go away. Should also note tax season selling equities. So let's see here. Tax day 2024. It's like what, April 15th? Taxes due April 15th. Let's say here let's say that the flows should always be. So, you know, one of the things with the notes here, because you kind of think that like, hey, I've got to have like this perfect formula and I got to do everything right and everything. But the reality is you're taking, some of these notes are most relevant to you like at that time. We can go on and if we wanted to create them in for something that was like a larger audience later, we can do that if we could modify it. But we don't need to do that. We can just kind of write what makes the most sense for us at that time. And so that means that we can change things anytime that we want, right? So let's make it so the flows are the things that are, that we know at the beginning of the session, whereas the news and events is trying to explain what actually happens, right? The flows are our prediction, and the news and events is kind of like what actually happens. Non-farms, flows, expectation. Now let's just say excessively higher than expected. Oops. Again. There we go. Okay. Oh, so I missed this other comment from you, Kyle. What I think both of us disagree with Powell is he is taking too long to give a cold shoulder to markets. I mean, it's been clear since December there won't be room for cuts this year, yet he keeps his language ambiguous. So I think you're hitting on something for sure. I wish that Powell was more forceful than he is, but at the same time, I think that Powell thinks that he is giving an accurate assessment, and I think that what he's saying is accurate. And again, what's happening is the market just hears what they want to hear, right? The market has this long-standing bias that, what will happen will be whatever is best for equities. And that is partly because that's just like what they want to have happen. And that's partly because the history is that stocks tend to go up. So if you always just assume that, if you always err on the side of things going up, then you'll do okay, right? So I kind of think that Powell can jawbone all he wants, and the market will just kind of still hear what they want. In order to actually have an impact on the market, he would have to be severely more hawkish than is justified by the current information, and would have to, start saying things that aren't actually very clear. Like, we're very, very concerned about inflation reaccelerating. We think that it's a very high probability that we're going to raise rates this year. Like, that's what I think he would have to start saying in order for the market to take notice. Because, in December, we kind of thought, okay, he's a little bit too easy, but maybe he will change in January. And then when January came along and the Fed speakers started talking, they did say the things that I wanted them to say, and the market just brushed it off and ignored it. So yeah, market's going to do what they're going to do, or whatever Powell says. Yeah. Like, case in point, watch what the S&P 500 does today, because I'm going to bet that they try, and unless there's another big scary headline, I'm going to bet that they're going to try and stage a rally. I bet you that they're going to try and stage a rally. They make a little bit of it back, but then stall. There will be at least some form of an attempt to spark a rally, like a short covering rally sort of a thing. They're almost certain to do it, I think. Let's see here. Oh, I didn't hear this from my news squawk, but on Twitter, I'm seeing them say Barkin. That's quite a strong jobs report. Well, okay. Oh, you know what? It's because my financial juice crashed. That tab has crashed on me a few times lately. I wonder what's going on with that. The Rock regrets endorsing Biden and says he won't endorse him again in 2024. Okay. If I was an actor, I would avoid talking about politics. Not because people that aren't in politics shouldn't talk about it or anything of the sort. And not because, well, let me kind of be a little more specific. Not because I'd be afraid of the backlash and that it could hurt my career. Maybe that's a factor. Not because I think that people should stay in their lane, but because if I was an actor, I would not feel confident about my understanding of the economy and the political situation and so on and so forth to be talking about it. I can talk about these things because, like, finance and politics is basically all of my free time. Would be funny to have something like in 2016 when they say one contract triggered so many stop losses, then the move was worth a total of 3 billion turnover. Well, I do think that there is something to that. The move yesterday was probably stronger than would be indicated just by the headlines that caused it because of the structure of the market at the time and so forth. Possibly. That everybody was long and they weren't really protected on the downside. And that the way the news came out and people weren't exactly sure what was triggering it and so forth, that kind of leads to the volatility lasting longer, right? And then on top of that, like the assets, the sequence of events that, like, you know, oil coming in and spiking up really, really high, right? So it's kind of funny, like, you want multiple flows, right? So if one of the flows is concerns that interest rates won't be cut, and the other fear is that oil prices are going to spike up and create a recession, that just means that many more people wanting to sell the S&P 500. It's just kind of like a perfect storm to have a 2% decline from the highs. It's pretty wild. Dude, reading Reddit yesterday was so wild. There was a number of people that posted they had puts. There was this one guy, he bought puts in the morning, which I'm kind of like, okay, why? But whatever. It's not like you thought that those headlines were going to happen. But he bought the puts, and then he lost like $5,000 on them or something and gave up. And if he had held it, they would be worth like 170 or something like that. It was like this crazy amount. There was another guy that like 6x'd his money off of 0 day to expiration puts, which is just wild. Okay, but the other thing was that the retail traders were very unsure what was happening, and I don't blame them, because it was not something that it just like it hit the news wire and then everybody knew. You can kind of point to the point that it happened, especially with Kashkari, when Kashkari spoke and when the market turned around. Okay. You can look at the news reports and what the desks said was the flows that they were seeing and everything. So I think that we have a pretty good idea of what happened. But when you go on Reddit and everything, they're all like, oh, just respect the price action. It's all just price action. No, because I'm going around and reading, and there's all these people that are like, I was reading the price action and it didn't do what it was supposed to do. Right? It's supposed to, it went down, it came up, and then when they go down again, they come up short, and then I go long, and that failed for me multiple times. That's what I'm reading, right? So the price action didn't work. Why? Because the news headline doesn't care about your price action. They hear the thing, they know they want out of the market, they don't care what the chart says at that time. But all these retail traders trying to argue in favor of that. They're like, well, it's a chicken and an egg. No, it's not. It's cause and effect, man. The news headline came out, people sold because of that headline. That simple. And then other people sold because they could tell that something was clearly up after that. It was just so weird. But like I've been saying, if all you ever do is come in and look at the charts and read quote unquote price action, that's basically the only thing that your brain knows, then yeah, it's gonna see price action. It's just like if all you've ever done is hammer things. All you've ever done is do a hammer, you're not gonna understand what a screw is. You're just gonna try and hammer it in. You've never seen a screw in your life. You're probably going to try and hammer it in and be like, what the heck is with this? So make sure that you're training your brain on, the full picture. All of the information that we have available to us that we know that has empirical backing or we know affects the market. Ugh. Interestingly enough, here on Twitter, I'm not seeing actually that much discussion about how the jobs number was a big winner again. And people are trying to talk about the deficit, like Jim Iorio. I saw, somebody made a really good point that I had not thought about before, but it was a really good point, is that the majority of the deficit in the United States right now comes from required spending, Medicare and Medicaid, Social Security. They're not discretionary. You could cut discretionary spending out completely and it wouldn't even begin to solve the problem, because the problem has to do with Social Security and so forth. And you can't just say, oh, okay, we'll inflate it away, because all of those things are indexed to inflation. So they do have to change those programs. They do have to change something to raise more money and change the structure of those programs. Yeah. After yesterday, I went to check on some Furu Discords just to see their reactions. And yes, it was a bunch of people saying, just follow price action. They always have the answer. Yeah. Did the price action tell you that it was going to sell? No. Because from and this is a funny thing too. You just know anytime that there's a big market decline of 1 to 2%. And I don't mean because it was only 1% down move on the day, but it was 2% from the high, depending on which index you're looking at. Okay. Retail traders tend to be long. So when you have a big down day than that, you're going to come back and you're going to look and all of those guys are going to be losing. Every freaking time. Right? Like if you're a day trader and you're really as great at this as you say, you should be making a bundle on a down move like this. But you go back and you look and usually these guys are all down. Everyone's a market wizard when there's a trend. That's the thing is that it's just the funniest thing is that the type of market that these guys have, when I'm talking price action, smart money concepts sort of traders, okay, which really is the most pure forms of technical analysis. They say it's not technical analysis, but it is the most pure traditional form of technical analysis. They've kind of tried to redefine technical analysis to mean lagging indicators, but technical analysis originally was higher highs, higher lows, patterns, dojis, right? And that's what price action traders are looking at. They struggle the most with strong trends and down days. Because those strategies are inherently mean reverting most of the time. You look at the setups that they're looking for, they most often are looking for a spot where it's going to fold back on itself or it's going to stay in a particular range. Okay. Because there's no edge in the pattern. The only edge that they may have in that strategy is volatility. They are looking at the volatility of the market and they're trading in an area where they think the volatility is likely to be low so that their target will get hit and their stop won't. And there's nothing special about the price that they're picking or any of that sort of stuff. Okay. So a strategy like that gets destroyed when there's a trend because it's going to go down. They're going to try buying the dip somewhere and just get destroyed over and over. And it's a trend. So it keeps happening over and over and over again. Right? What do you want to do on a trend? Know that the trend is coming, get in early and just ride it. Because if you try and get in halfway through, it's come back and look at this 5-minute chart. And look at how much these candles are folding back on each other, right? Over here, it's all single prints, right? These prices were only touched once, whereas below that, these prices were touched multiple times. These prices were touched multiple times. These prices were touched multiple times. Okay. There's a little gap right here, but these were all okay. These are all areas right here where you could be right and get stopped out. So where do you actually want to be short from? You want to be short from right here. That's the best spot. You're short from right there. You can just let it ride. And you don't have to take a bunch of different trades or anything. You just kind of sit there and laugh as everybody else is panicking. That's what you want to do on a trend. It's completely antithetical to the entire kind of price action thing because they're almost always looking for mean reversion trades. Then on top of that, they're all equity traders. They're all equity traders or they're trading the indexes in some form or another. And so part of their edge is to have a bias to go long. So they always tend to go long. And so then when there's a big winner that you could make on the short side, they miss it. Yeah. So yeah, reading social media yesterday was funny, but it was like, because I had people arguing. You want to see some of the ones that were arguing with me? It was like, here it is right here. It's this. So I said, what happened? Then this person says, this is a chicken or egg problem. I often find we try to explain price action after the fact with news. Just respect price action, S&R price levels. This is a classic thing for a price action trader to say. Well, listen, I can tell you pretty confidently, that's why people sold, right? Orders have impact. Why did people submit those orders? It's because of the news. The news was directly responsible for those orders coming on. And then everything else after that was just cascading effects, secondary effects from the people initially selling because of that news headline. Okay. In your world, because you never look at the news, because you're not looking for predictors of order flow, you're only watching what the price did afterwards. You can never explain why it did anything. If there wasn't some sort of price action signal that you were getting, then you can't explain why it moved. Okay, but it did move. So I said it's not a chicken and egg problem. This is pure cause and effect. When a piece of information like that comes out, lots of people will sell, causing price to decline. If the story is a nothing burger, they will often buy it right back up. Nothing else can explain that except for the very thing that is inducing people to sell, the headline. It's really that simple. And then I said, it's almost comical to tell people to respect price action in this sort of situation, because from reading the social media today, all the price action traders were long and got burned on this move. So then they started arguing with me. The problem is no one knows if today's selling is algo hedging, shorts opening new positions, lack of buyers, long selling, or if this is just a stop hunt flush. Actually, we can. So first of all, I can tell you there was a net sell in balance market orders, which, okay, is that existing positions or like new positions opening? Doesn't matter. Market orders selling. And then the question is, why are those market orders selling? Well, we can talk to the desks and we can ask the desks, okay, what were your clients telling you? Well, our clients were telling us they were concerned about, an attack in Israel and oil going higher. So they sold their equities. That's what they told us. See, and then here's this other person in here. They quote, we try to explain price action after the fact, just respect price action. Perfectly right. Markets acts first, and then news media find assigning convincing reasons so that the viewers believe it. No, it's not. The news came first. You can go and see the exact moment that Kashkari spoke and said the thing that he said, and the reaction after. It's not in the interest of the market for people to look closer at what may be moving it behind the scenes, I guess, as somebody responded to that. The crazy thing is that this guy is getting a couple of people upvoting. So, we did this Monte Carlo simulation. I should check that again in my repository, see that I have the repository really good, maybe put a picture in there so that when people go, they can see what it is and submit it somewhere or something like that. Because the Monte Carlo simulation says that 30% of combines should pass just based on a random walk of a strategy that, should be break even based on its risk reward and win percentage. Right? Why is it that retail traders don't succeed as much as the Monte Carlo simulation says they should? Well, it's because they have so many wrong ideas. They are taught so many, the majority opinion that you're going to read on social media, which is that you just need to look at price action and technical analysis is everything, is completely wrong. Especially on a day trading time frame. The reason they came up with all of this stuff was because they heard these guys in the 80s saying, you know, just use the technicals and just do what's going to happen. And, you know, like you will get in before like the big thing happens and you'll just ride this huge wave and yada, yada. They were swing trading, guys. They were swing trading. It's a different thing. Because, yeah, you could have them that they could be making a move and it's going to move it over a day before like everybody knows. And then it's just going to keep going. But like when we're talking about something where like all of the sudden the market just, you know, dropped 2%, it's not price action, man. It's a news headline. Come on. And if you're day trading, you should be more interested and should know more about the news headlines, okay? Because that's what's the most dominant on the intraday time frame. I listened back to this morning's stream and had a question, very basic, but why did bonds sell off this morning when the dollar dipped? Shouldn't money have flowed into bonds too based on the news? No. So, okay, wait, that's the non-farm. Well, if you're using a trading style that's based on something like that, you are very reactive and so can be very easily manipulated. You just react to whatever. Yeah, exactly. That's very true. You got to realize that like an institutional trader, like especially these block traders, right? They're selling in the market. They've already bought it, right? Like they've already said, somebody else has said, I need to sell this much. And they say, okay, we can do it for X amount, right? And then they can sell it for a higher, you know, if they can execute for a higher price than that, then they make the money, right? So all they've got to do is sell it and have as little impact on the market as possible. And that's how they make their money, right? And they can it doesn't matter what the market is doing, right? Because they're the ones that are acting. And so they can adjust their actions to whatever the market condition is. And yes, that includes like sell it down and then pause your selling, let it come back up, sell it a little bit more, but don't sell too much so that people think that it's a higher low and they all start buying it. And then when they start buying it, you're there absorbing contracts and you're selling the rest of it against them. Right? And they can totally create these setups. If I tell you whatever is the popular retail strategy, like popular technical analysis retail strategy, watch it and wait for a time where you think it's going to fail. Look for a time where you've got that set up, and based on the news and the flows that you have, it makes absolutely no sense why that particular setup would work, and sell that one. Because those tend to be some of my best winners. Okay, so Dylan, the news that we got was that the employment report was very, very strong. So this whole time, the market has been anticipating that interest rates will be cut. You cannot cut interest rates when the jobs market is that strong. Okay, so that means you're not going to get rate cuts. And that's why they sell the treasuries. So you think of it as like, okay, rates are here. They think that they're going to come down to here. And now the information is saying they're going to stay here. Okay. So rates are going to stay higher. Higher rates means lower treasury prices, and they sell. And that's all I have to do to sort that out. Or rather, I would say if the number is higher than expected, I should expect the treasuries to sell. And if the number is lower than expected, then I should expect the treasuries to buy. Okay. Now, that reaction function kind of shifts with equities to some extent, right? Because it depends on whether the equities care more about that the strong job market is going to lead to more earnings versus the higher interest rates are going to hurt their valuations. So that can kind of depend on this situation. There is dumb volume trading at every price, regardless of price, because they think market is efficient and they are just getting the best price. Yes, so we know that the market is not efficient. Is the illusion, or let's call it the lie, that the market is efficient necessary in order to have enough liquidity to trade? I hope not. I hope not. Because I think someday it's just going to become obvious that the market is not efficient. But I actually would probably argue probably not, because understanding that the market is not efficient will just give people all the more reason to want to come in and try and play the game, right? And that will probably create more. That will probably create more liquidity. The news is usually just temporary noise. There's, of course, some news which is important, but the vast majority don't mean a thing. Well, if you wanted to catch the sell yesterday, you needed to know the news, right? You're correct in that what happened that one day probably doesn't mean a whole lot in the larger trajectory of things, unless this is the beginning of a bear market. Okay, if this is the beginning of a bear market and a recession and a what, yada, 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 everybody's going to point to this week as this is when it started and when you could have known that things were going on and why didn't you sell here and yada, 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 right? But that just brings me back to, again, all of this stuff that retail traders have learned about technical analysis. They learned from momentum traders trading a swing strategy where they are trading a portfolio of multiple instruments with positions that they can hold for months. And you're taking that and you're trying to apply the exact same entry conditions and ideas to a daily time frame. It's silly to think that would work. Because on the daily time frame, the news is the most dominant factor, is the most dominant flow that you can have, is a really big market moving headline that comes out. And we got 2 yesterday. And if you can't deal with the news, if you don't watch the news, you don't, see how the market reacts and understand what's going on so that you can take advantage of it, then you're very unlikely to have success on a day like that. And the problem is that you will lose so much on days like that it will just cancel out everything else you make. For a retail trader, at least. Robots, maybe can get away with it. Okay. TLA says something else. There are many different giant traders in the market. There's no one who can control the market. So yes and no. The ability for one large player to dominate the market on any one single day, it absolutely happens. I know for a fact that it happens because I've literally sat there and watched them do it. Especially when you're talking about a single stock. Oh my gosh. Okay. So remember what I did when I worked for the bank. I did a bunch of different things. It's kind of funny. I've held my positions at companies for a long time. Most people, they like move every 2 years, right? And I've been at the companies that I did 6 years, was 2016 until 2024. So that's 8 years, 6 years, 8 years. But I did multiple roles within those companies. So I actually move every 2 years too. It's just that they moved me within that company, but I digress. The last thing that I did at Goldman was the risk management system, which meant that I could see the position, every stock and every position that every institutional client that worked with that bank had. Trillions of dollars, I could see all of their positions. And one of the things that would happen is they would say, hey, this company, they're doing a large acquisition. They are going to buy 10% of the shares of X company. And so in order to do that, we need to raise their credit limit temporarily for the day while they're doing this operation, right? They would, and then we would be the ones that would go in and override the system for them so that they could do that, so that they could breach those limits. I would keep track of that. Oh, what is it that they are buying? When did it happen? And if they were buying or they were selling something, every time, there was never a single case where it did not come out otherwise. Every single time, if they were buying, that stock was up the next day. Every single time. And why was that? Because they were buying it, man. They were buying it. They were moving it. Yeah, there's these funds with billions of dollars, and they can buy 10% of a company in a day. Well, that was something like, if 10%, you're probably doing over a week or multiple weeks, and during the time that they are doing their thing, that is the dominant factor in that stock, 100%. Okay, so let's see here. If there was no new information and news, then price wouldn't change. But think about it. If there was no news, then price would be pushed to liquidate positions. Maybe. So you would just got to keep in mind that they've done many studies, and the studies all come out to that there is more volatility in the market than we would expect. And there are even large moves. There are large moves that are not driven by news. There are large moves that happen in the market that appear to be completely endogenous, meaning that they are just caused by people within the stock market getting stopped out of a position or whatever the deal, and it has nothing to do with if there was a piece of news. That happens too, okay? So not every big move is news driven. And in fact, probably the minority of the large moves are news driven. In fact, there's just a lot more volatility than the informational content suggests. Okay. But there can be big players buying or selling the market at large that, again, the best example, because this is an extremely powerful flow in the markets, guys. Don't sleep on this one. Okay. Funds rebalancing at the end of the month and the end of the quarter is a huge driver of order flows in the stock market. And this is a very predictable flow that you can get good trades off of. Unfortunately, it's something that you can only get 2 or 3 days a month. but it is a very powerful flow, right? That's something that moves the market very, very much, and it has nothing to do with informational content, right? Okay. Now, if there are no flows whatsoever, and that does happen, especially in the treasuries, we'll see, there's none of those things going on. Does the market just sniff out people's positions during that kind of action? I'm going to say I don't know, because everything that I've done studying those kinds of areas is just no different than random from what I can see. No different from random from what I can see. So, I don't know. Yeah. But again, like, this is a really, really big kind of like piece of information that I'm giving you, right? Like, this is one of those demystifying the markets thing, is that the market can move because of orders, and those orders do not necessarily have to have informational content behind them. Because all of the classical models of economics assume that if the market is moving, that it's because there's information and they know something. But it's not just that it doesn't have to have order, that it doesn't have to have informational content behind it. The big secret that I'm giving you here right now is that in the modern market, the largest flows do not have informational content behind them, because the biggest flows are the passive investors. And the passive investors don't care what Israel just did. They don't necessarily care what the price of oil is. All they care about is how many redemptions and contributions they had into their fund that month, and how much they need to rebalance based on their publicly available strategy and their prospectus. And those are the biggest flows in today's market. And that's how you're able to have these hedge funds that are able to predict flows and make so much money. Is it just me, or are volumes light? Yeah, I think I would say that things are relatively light here. Now, remember, I said that I bet you that the equity market will try and stage a rally. They are doing it. But and I also said I don't want to take a short here because I'm too concerned about the chances of them coming to 24, and look at where they're at right now, as they're at 24. That's so funny. I think it can't be. Is this just random? I mean, there's no way for me to know. I want to do some more research on this, but here, this 24 was like a 90-day new low or something like that. And they pushed through it, and there's all sorts of crazy. And now, the rest of the week, they've just been toying with that price level every day. Anyways. On a day like today, the profitable traders, they traded the non-farms number. They got in on that initial action. They made money, and then they go home. And the later in the day you get, the worse the trades are for you. and especially after, so now it's 8 o'clock, especially after the first 30 minutes of the S&P 500, there is often just no reason to do anything on a Friday. Now, I think there's still a pretty high chance of there being like news. Market is concerned that something will happen over the weekend with Israel, right? So there could still be cray things, but I'm not going to be taking any trades. You can make money by sitting on the bid of ZB 10 ticks away from current price and getting filled by a massive order like I did? Well, wait. So are you saying we're at 1722 and I put it in at 1712? And then I just hold it there and it comes to me? Or are you saying if it ticks down to, now that it's ticked up to 1724, I will move my bid to 1714? And in order for me to ever get filled, there will just have to be like a really big move that snaps down and tags me real quick and then reverses a little bit? Because if that's what you're saying, you're probably right, but that's an awfully tedious way to trade. He says the latter. Yes. Oh man, are you really doing that? And so tell me then, how many times have you actually gotten filled on that? Because in this market, I can, assuming that you're not doing this during news, I can only think of like maybe 3 times. One time. Hey, if it works, it works. That's crazy, dude. Oh, you weren't even intending. Yeah. But you're not wrong. You're not wrong. There's a reason why there's these orders that are like 2 ticks away that follow it up and down on every tick, right? That is an edge. You want to be at the front of the queue. There's competition for that edge, but there is an edge to it. There is an edge to it that if you get an impulse where it moves multiple ticks all at once, extremely likely for it to come back a little bit. And the market makers that can hold a lot of contracts, you know, your one lot and 2 ticks might not work out, but a big trader, they're able to trade enough size and everything to make it work out. And there were people that back in the day before the robots took over would just, you know, it tick up and they would be one of those first people that would put a bid in. Tedious way to trade, but somebody's got to do it. Now we have robots that do it. It was such a slow market too, but I imagine if it's fast market, it's possible. So I had somebody message me on Reddit here asking about where I got my news from. So I'm glad that at least one person read that exchange on the day trading subreddit and said, yeah, these other people are crazy. I want to talk to the guy that knew what was actually going on and how does he know that stuff. And then I pointed them to the Discord. So oh, somebody here was Mr. a Hawk. I can remember some headlines with Mester lately where the market moved because she was too hawkish and the market moved because she was too dovish. So I'd say she's mixed, but she is a Democrat and she does seem to lean slightly dovish. Republicans tend to be hawkish and Democrats tend to be dovish. Oh, I can minimize this too. What is this person talking about? Does a position act as information in the market? Suppose I had the ability to open 500K position? No, I don't think so. Well, in within the definition of information that I was talking about, information would be there's a piece of news and I'm trading that piece of news. I have a piece of information that I don't think is factored into the market, and I am trying to make money trading off of that piece of information. And so by trading, I move the price and ergo factor that into the price of the thing, right? So that's what we mean by informational content. The knowledge, for instance, that somebody else is going to buy or sell would, under that definition, not necessarily count as information unless there was information behind why they were going to buy or sell, right? Like they're going to buy or sell because they know that, you know, Israel's going to get attacked this weekend or something like that. So a very narrow definition of information that is very closely related to like empirical studies that people have done. Which data feed provider do you use / recommend? So as with anything in the futures market, it's super, super competitive. And so they have to specialize. So what the best data provider for you is going to depend very greatly on a number of things. Okay. The biggest one is who your broker is. The way that this typically works is pick your platform, find a broker that uses that platform, and then see what the data options that they have are. Okay. So for me, well, for most places, you go to like AMP Futures or EdgeClear. You're going to be given the choice between Rhythmic and CQG. Okay. If you are trading equities and you want to look at things like the tick index that tell you how many stocks of the index are moving up versus moving down at that particular time, and some of these other things that tell you like total volume across the whole index, buy and sell, etc., etc. To get those indexes, you probably want to use CQG. If you want to see a level 2 really far away from current price, like these big orders that are like 32 ticks away, you know, like here on my DOM, I can see orders, you know, really far away, orders that there's no way that they would even get filled today, right? Then you're going to want to use Rhythmic. So I want to see the orders, I use Rhythmic. The other thing with Rhythmic is that Rhythmic Trader Pro is written in C# and ergo can share its data with any other C# application. So I can use Rhythmic and pass the data to NinjaTrader and Jigsaw together. And therefore, the thing is, if Rhythmic Trader Pro crashed, then I'd be host. But that literally never happens because it's not doing anything. It's just sitting there. I don't have anything open. Whereas if I do CQG, like let's say I go to NinjaTrader, I think my platform is going to be NinjaTrader and NinjaTrader only. Then their data provider is Continuum, which is basically a not as good CQG data. Okay. Then if I still wanted to use Jigsaw, I would have to use the NinjaTrader bridge, which means that if NinjaTrader crashes, which it can do sometimes still, then you would stop getting the data in your Jigsaw. And that's why I use the setup that I do. Because otherwise, you know, I would prefer to use my full Jigsaw license. Or sorry, my full NinjaTrader license, but I can't because my full NinjaTrader license only gives me CQG. It doesn't give me Rhythmic for NinjaTrader brokerage because that's not a thing anymore, apparently. Who is best for execution? You know, I don't know if I've ever really seen that tested. Probably it's Trading Technologies. Trading Technologies has the best data, but it's very expensive, right? But I think that overall that's not a serious consideration for most retail traders because you're executing manually, right? If you had a robot and you were running servers co-located at the exchange or that sort of a thing, then that sort of stuff would matter, and I don't know what the answer would be. Yes, my understanding is that Trading Technologies were the first ones to do the DOM, period. Most of the way that the DOM is set up and that came from Trading Technologies. Like a big one is at the current price showing what the last traded amount was. That, instead of the volume profile, I think it is. That came from X-Trader Pro, whatever, which was Trading Technologies back in the day. Okay, Jeremax asked, well, informed trader could be the trader who knows the future orders he will place. Okay, but the question is, why is he placing those future orders? Is he placing those future orders to express an opinion about the market? Or is he placing those future orders to rebalance his portfolio, right? Because if it's rebalancing his portfolio, that tells us nothing about the broader economic conditions as a whole. And therefore we say that's not informational content, right? I've seen footage after the pits were closed where traders were using the DOM from TT. Yeah. They've been around for a long time. Well, since the 90s. It was the thing in the 90s. Looks like they've extended quite a bit above 24. Are they going to retrace this whole move? Wait. Where would they? Okay, so they need to come back to 110 to retrace the whole move. Maybe they could do it. I don't know. This just comes back to, again, on a non-farms Friday like this, we should expect to see things that don't make a whole lot of sense. For instance, there could be somebody that they knew that the non-farms was going to be really big. They'd been short for days, and now they're just taking their profits, and that's why it comes back up. Is ZB already higher? No, not quite. Theirs is 108.04. So they're awfully close, though. Yeah, my mustache is tickling me again today. You have it higher than... Here's ZB. Here's the move. 630, 631, 118.04. All three of them are still down. But they've recovered so much of it, I think there's a pretty high probability that they do completely retrace it. Now, one thing might be that if your flight to safety because you're concerned about oil and attacks over the weekend and everything, you could buy it. That could be another reason for this flow, right? Oh, you were looking at a range chart. Oh, yeah. Okay. That makes sense. Well, so we haven't come in and seen what Zero Hedge thought about the unemployment numbers. So let's see if we find that. Yeah. Okay. So they have one story that says MOAB is greater than non-farms payroll. MOAB as a euphemism for the geopolitical risk outweighs the non-farms payroll report today. That may be the case. I'm not a big enough risk taker to play that one. I'd rather stay out and let them see what happens over the weekend and then decide what to do based on that on Monday, right? Okay, yeah, so I didn't see anything else, so let's read their story. March jobs come in red hot at 303K above highest estimate as unemployment rate drops. As we wrote in our preview, while big data hinted at a weaker than expected March jobs print, the relentless influx of immigrants would lead to a hotter than expected payrolls number. Sure enough, the illegals won again when moments ago the BLS reported that in March, the U.S. added a whopping 303,000 jobs, tied for the highest since January of 2023. The number was not only hotter than last month's revised number of 270K, but was above the highest Wall Street estimate of 290K. And as shown below, this was the latest multiple sigma beat to expectations this month, coming in at 4x. So wait, how do you get like a 4 sigma beat when we get a 4 sigma beat every time? Well, whatever. The March number, which will be revised substantially lower next month, probably, follows two downward revisions, which follows a $5,000 job downward revision to the February number and a 27,000 upward revision to January. What is perhaps more notable is that after several months of declines in the household survey, in March, the number of people actually employed finally rebounded, rising by 498K. Still, as shown below, the data series has a lot of catching up to do, and then they point to the household versus establishment survey. You can see that the household survey going up after having been declined for the past 2 months, but still a big gap between the household and establishment surveys, which may be a kind of a larger divergence that's always there and we just haven't noticed or something. If I could go back and see all the way to 1980 and see that they track each other really well, then maybe I would make a bigger deal out of that, but I digress. You be careful, because Zero Hedge plays games like that. Okay. Turning our attention to the unemployment rate, it unexpectedly dipped again, dropping to 3.8 from 3.9, in line with estimates, as the number of unemployed workers dipped modestly from 6.485 million, while the number of employed workers rose by almost 500,000 workers. The unemployment rate for blacks increased in March to the highest level in almost 2 years, while the rates for Asians and Hispanics decreased. The jobless rate for adult men, adult women, teenagers, and whites showed little to no change. In contrast, the participation rate rose from 62.5 to 62.7. above the 62.6 expected, as the overall civilian labor force increased slightly less than the number of employed people. The silver lining to today's jobs report is that despite the hot print, the average hourly earnings came in as expected, rising spot 3 month over month, up from last month's upward revised spot 2 sequential increase. On an annual basis, the hourly earnings rose 4.1% as expected. This was the lowest print in almost 3 years. The last time wages rose by this much was the summer of 2021. Taking a look at wages in March, average hourly earnings for all employees on private non-farm payrolls increased by 12 cents. Over the last 12 months, average hourly earnings increased by 4.1%. In March, average hourly earnings of private sector production non-supervisory employees edged up by 7 cents. They want to put in all of the numbers, but like the numbers, I'm kind of like, I don't care. Just tell me, like, was it higher or lower, more than expected, etc., etc. One reason why hourly earnings did not increase in March, the average work week for all employees on private non-farm payrolls edged up by 0.1 hour. In manufacturing, the average work week was unchanged at 40 hours and overtime edged down, blah, blah. According to BLS, the number of people not in the labor force who want a job came in little changed. These individuals were not counted as unemployed because they were not actively looking for work during the 4 weeks preceding the survey and were unavailable to take a job. According to the report, the number of people employed part-time for economic reasons at 4.3 million. These individuals who would have preferred full-time employment were working part-time because their hours had been reduced or they were unable to find full-time jobs. Finally, the BLS reports that among those not in the labor force who wanted a job, the number of people marginally attached to the labor force was little changed. These individuals wanted and were available for work and had looked for jobs sometime in the prior 12 months, but had not looked in the 4 weeks preceding the survey. The number of discouraged workers, a subset of marginally attached who believed that no jobs were available to them, was little changed. They're going to go down by industry. I'm not going to talk about that. A closer look at the best performing job category under Biden government in March. This added 71,000, the second most since the start of 2023. Healthcare added 72,000. Government added 71,000. Construction 39. Leisure and hospitality 49. Finally, for those wondering if the jobs were all part-time, the answer is a resounding yes. In March, full-time jobs dropped by 6,000 as part-time jobs soared by 691,000. Okay. What is Wall Street's reaction? Here are some hot takes, starting with Bloomberg's Edna Curran, who writes that since it's an election year, these numbers will be trumped by the White House as evidence of their stewardship. The downside, however, is that they lean against calls for a rate cut, something of a double-edged political sword, yes. Echoing this, Torsten Slok, Apollo resident and House Permabear, who will never relax until you have sold all your assets to Apollo, writes that the number confirms the Fed will not cut rates this year. We are sticking to our view that the Fed will not cut interest rates this year. The source of this strength is easy financial conditions. The stock market is up $10 trillion over the past 5 months, which is a significant wealth gain for household balance sheets. Credit spreads are tighter for loans. A big rebound in IG issuance and HY issuance in January, February, March. IPO activity is coming back. M&A activity is coming back. These factors will support consumer spending, CapEx spending, and hiring over the coming quarters. Here is Shima Shah, Chief Global Strategist of Principal Asset Management. Chief Global Strategist, Principal Asset Management. At first, the jobs report leans against 3 cuts, yet the average hourly earnings figures are in line with expectations. And as Powell has made quite clear in recent speeches, a strong labor market is not a concern if price pressures are moderating. Next week's CPI report is the one that is pivotal for rate expectations, but today's report should reassure markets that if the Fed does not cut in June, it's because the economy is still strong and earnings should remain in an upswing. Priya Misra, portfolio manager at JP Morgan, says if service inflation has shown signs of picking up in the CPI and PCE reports later this month, Fed's patience might run thin. The market reaction makes sense to me. Higher rates and weaker risk sentiment. I think risk assets are paying attention to rates now. Risk assets ignored the rates move until this week, since January and February could be glossed over as noise. But if the economy is staying too hot, the market should question Fed cuts and the specter of Fed hikes comes back to the market. Ed Al Hosseini, rates strategist at Columbia Threadneedle Investments, says the key question is whether the combination of higher demand growth, momentum in employment, and the easing of financial conditions since last October start to show up in inflation. We'll get another look at that in CPI, PPI data next week. Ali Jaffrey, an economist at CIBC Capital Markets, sees immigration playing a role in today's markets. This has raised a substantial sustainable level of job gains from 100K before the pandemic to about 180K. Today's data is likely more evidence of that trend and supports the Fed's view that the increase in labor supply is driving growth in the job market and the economy more broadly. Overall, the March employment report leans against an earlier cut by the Fed. Bryce Dottie, SIT Investment Associates. Incredibly strong jobs data puts the bond market in panic mode over Fed cuts being delayed. But I keep scratching my head wondering why so many people are deciding to get jobs now when millions of job openings have been available for at least a couple of years. It's not as though the economy suddenly produced these jobs, so people joining the workforce now must need the jobs. As a result, I'm cautious about how strong the jobs data really is for the economy. We expect a 1/4 point cut in the third quarter and a 1/2 point cut in the fourth quarter. So they're still expecting some economic weakness to come in that requires rate cuts. Then we close with Bloomberg's Edna Curran, who writes that at face value, these jobs numbers hardly lend themselves to a near-term rate cut. Bottom line, strong report until you look under the surface. For now, however, it will serve the White House to pitch Bidenomics as some miraculous economic panacea, while the market will try to soothe itself that the number was good but not hot enough to prevent Powell from cutting rates in June. Okay. They make a good point, though, that the inflation data that we get next week, and especially the inflation data that we will get at the end of the month and then next month, probably matters more. And so while this jobs data is concerning and the knee-jerk reaction, I think, is appropriate, it also shouldn't surprise us to see a lot of that retraced and so forth, because there's a lot of reasons to be looking past that news. There's other things going on. And again, there is still geopolitical risk, etc., to be concerned about. So lots going on. I mean, we got a lot of things listed in our flows here, right? Whew. That was a pretty long article to read. I got tongue-tied there a few times. See, that's when I go, people would be like, oh, see, he's losing it. Seth is not competent enough to be president, because I think that everybody has that sometimes when they're reading something. Because Joe is always reading something, by the way. Doesn't use his own words. So if we are trading the yield curve and the Fed begins cutting rates, should we expect to see a jump in ZT? Yes. I thought I was crazy, but my office chair was moving and it just had an earthquake of 4.8 to 5. Well, that's a decently sized earthquake. How big was the earthquake that we had here in Utah? That was in 2020. That was a 5.7. New York. Uh-oh, you're in the range of the eclipse. That could be pre-waves for the big one. Oh no. I've seen a lot of stories and people trying to fearmonger about bad things are going to happen at the eclipse and everything. Does that actually get people content? Because I just ignore it. I don't know. being when an eclipse like fully covers it really is something. I've never seen it live, but when it was like 90%, it was pretty crazy. So look for the map showing the Airbnb listing across America that are booked. It makes a funny little line through. Yeah. Well, when this happened before, I thought about, doing something, but they were already like booked out like way earlier. And I didn't want to drive that far that day, so I didn't go and drive over to Wendover, or sorry, Elko, to be able to see it. Woulda, coulda, shoulda. I guess I could fly to go and see it, but this is gonna be crazy. A news story that I keep kind of seeing brewing out there is that there's a bird flu pandemic that they're concerned could jump to humans. But I kind of feel like it's a little bit too early to be scared about that. Again, maybe they just don't have a whole lot of good stories going on right now, Media's throwing things at the wall, see what sticks. Oh, wow. I've come across a number of shocking news stories today that I'm like, this is kind of shocking, but this is not relevant to us at all. So I don't say anything. I guess now that I'm saying this, I should say something, right? A family of a Portland girl filed a $9 million lawsuit against a public school district after the young girl was allegedly gang raped by two boys in his school bathroom. They alleged that the district and nonprofit after-school program failed to protect the youngster. According to the lawsuit, two male students of the program told the girl they would find out where she lives if she didn't tell the staff she needed to use the bathroom. So she complied and went to the bathroom. As the other students followed her, locked her in a stall, took off her pants, and forcibly raped her. She tried to ward them off. They made it impossible for her to escape. She's in 4th grade? What the F? And the father of one of the boys reported the incident, and his son and the other boy were suspended for 1 day. Are you kidding me? You gang rape somebody and you get suspended for a day and not like kicked out of the school? Crazy. That's so crazy. Anyways, not relevant to the markets, but that was there, and I guess I couldn't help it. Oh, the CERN collider worked. Is that let me find that CERN collider, because they were turning it back on, huh? And everybody's like, "Oh, things are gonna go crazy again. They're gonna start splitting the timeline again." No, I don't think that they've turned it back on yet. Yeah, there's a lot of weird conspiracy theories about the eclipse, though. You're just kidding. Okay. I mean, it is supposed to go. It is supposed to be, like they've kind of been in a maintenance mode for a little while, and they are supposed to be like spinning it up again soon. Wow. Oh, let's see. This looks interesting. From r/day trading, I blew my account 6 times and now I have no money to trade. These are the reasons why, guys. Always trade small enough that you can just trade forever. This is what I say. Okay, so advice. I have just been looking at charts and make my decisions based on instinct, which was a big reason. I've been trading on impulse, no reasoning, no strategy. Trading with no discipline. And not trading from level to level. Why? Support and resistance doesn't necessarily matter. He thinks he should have analyzed the charts, look for breakouts, and only trade when in a range and not impulse trade. Look out for a healthy market structure and not chase bumps and dumps. Look for formations and trade level to level. I think that you're going to blow your account doing that too, buddy. But okay. I don't know how I'm going to make money now. I'm literally at 0. I'm like... I feel like I'm a good day trader, but my emotions have been the reason for my downfall. Oh, yes, no. Okay, so what's really happening here was this is what your strategy was supposed to be, and you think that you stopped trading your strategy. So then the first thing is like, why did you stop trading your strategy? You think that it was just emotion? Because oftentimes you are seeing something and you are trading your strategy and it's just not working, and you make excuses for that it's not working, that I'm trading it wrong, when actually... your strategy is prone to doing that. Yeah. You blew 6 accounts and you're still not aware of your biggest mistake, lack of risk management? Yeah, I don't know. It kind of sounds to me like... I don't know, man. Maybe trading's not for this guy, but... It's like saying you overtrade when you don't have a strategy and you see an entry on every tick. Yeah, but this is what I'm saying, is that it sounds to me like this guy is, what he's trying to say is that he does have a strategy and he doesn't think that he traded his strategy. And so then the question at that point is, why did you not trade your strategy? Right? Because it's either there's something about your strategy that is making it difficult for you to continue trading it, or you're actually fooling yourself. You were trading your strategy and it's just not working because the discretionary nature of it is that you're losing. You know, like... But if you are... the whole thing is that if he does stick to his strategy and he employs proper risk management, I'm going to bet you he still loses. Because from what he's saying, it doesn't sound to me like he has any real edge. He just believes the things that everybody else says and just kind of thought that he could wing it. Right? And then when he winged it, he'd realize, no, I'm actually not doing what I think I'm supposed to. Because obviously, if I did what I was supposed to, then I should be profitable, right? So you see what I mean? Like, when you're reading these sorts of things, you kind of have to try and think about things from their perspective and see where they might be lying to themselves or misinterpreting it, right? So if I truly believe that something has an edge, but I'm not making money from it, then I must be doing it wrong, right? There's never any question about maybe the strategy is just not good, right? And so that's why my first question is, why did you actually break from your strategy? Because more often than not, I find that there is something about the strategy that causes you to do that. Like, you start losing, and so then you depart from the strategy. Right? Like, when I'm losing, I look at that market and I say, well, what's really driving this market? And are they flows that I understand? And usually it's, I don't understand those flows. I didn't see them coming, and that's why I'm losing, right? I don't think that blowing 6 accounts, is a concern. Because most traders, especially if you've been trading for years and years and years, you're going to go through times where you have to put more money into the account. I wouldn't necessarily say that I've blown accounts, because to me, blowing an account is like you get margin called and they ask you for more money, sort of a thing. That's never happened to me. But I have put more money in accounts. what, 6 times? And how long have you been doing it for? I don't know. But like, you should never get to the point where if I blow this account, I won't be able to refund it again, right? If I'm in that situation, I just trade a lot lighter, give myself more time to build up, my backup or whatever. So basically, the way that this is going, it kind of sounds to me like this guy maybe shouldn't be trading. That his ability to take on risk is probably not high enough for him to really ever be successful with it. But it's curious to me that that's the attention in what he said in there and so forth. Comments in here aren't really that interesting, though. Trading a range is a good idea, but it's not a strategy. Trading a range is a strategy that has severe limitations and flaws. The reason why the retail traders are kind of lean towards that sort of a strategy is because it is something that's going to work most of the time, but it has tails. When you have a trend day, that strategy is going to get destroyed. Doesn't surprise me whatsoever that this guy, based on what he says he's trying to do, that today is the day that he posts that. Because probably he tried fading that trend and got screwed, right? And then he says, oh, it wasn't actually my setup. I thought that it should reverse here, but I wasn't actually looking at support and resistance. I shouldn't be trading on a trend. Well, how did you know that it was going to trend or not trend? If you're just looking at the movement, you can't know. Frankly, if you're just looking at the movement and you see an impulsive move like that, there's a pretty good chance that that does reverse, right? The only way I think that you can know is to know the informational content, because what really determines how far a trend goes is how many orders are trading it, right? How persistent that order flow is. And if it's like a panic headline where all of the algos sell on it and then everybody else realizes that it's a nothing burger, then that flow is going to stop and reverse. You can only predict the number of orders by knowing the informational content. That's why I say it's an idea, not a strategy. For strategy, you gotta find an edge for the entry and condition to get in, besides the fact that it's support and resistance there. Like if someone sleeps with the head of the buy button and the resistance, yeah. But my point was that even if you had some like algorithmically tested, setup in there, I would be absolutely stunned if you were able to make a back test that passed all of my qualifications, over a 5-year time period and yada, 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 that would be successful in that situation. Oh, it's 8:52. Just a few minutes left. You know, I was kind of thinking about reading you my thing about having to do with momentum. I don't know. I really still feel like I could make that stronger, but I don't know if I can. And I kind of want to record it tomorrow. So I think I'm going to go with mostly what I have. I'll probably practice tonight and record it tomorrow. Because there will be no family and children tomorrow morning. So I should be able to record it before they come back when it's quiet. So I just need to do it then. Maybe I'll even get some time today to work on it on a Friday. I've been pretty busy this week though at work. House Republicans have proposed a new 23% national sales tax. Yeah, and he doesn't mention that that would also, like, eliminate all other taxes. 23rd January. Oh, this is from forever ago. Republicans are substantially less likely to understand how marginal tax rate. Yeah, that's true. That's true. That's funny. That they need to do a study to see that, but yeah. I'll read that thread. All right. Well, I don't really see anything else that I feel is like super essential before I leave you guys. Be super careful trading on Fridays, guys, especially after this time, because the trades tend to suck. But just keep in mind, could be some volatility because the geopolitical risk is still out there and everything. Could be an interesting weekend, but it could come back on Monday and be like everything's fine and the S&P 500 start rallying back up again. Yeah. I'm interested to try and learn to code my own strategies. Well, this would be a great stream to watch because, you know, if you ask me a question, I can totally get on here and program and walk you through it, right? Because a lot of programming is just like, you know, going through explicit examples and learning, right? You have to learn by doing. And that can be hard when you're a beginner because, you know, you might not have the skills to debug and find everything that you need on your own. And that's where I can come in and help you because I stream is small enough that I can take the time out to answer a question like that. But I got to go for now. So I will see you guys. My little fidget toy fell out of my hand. I will see you guys on Monday. In the meantime, stay excellent.